In this session, let's look at another important function of the finance manager. How does he manage the dividends, and how does he manage the repurchase, buyback of the shares? What are these two things? What is the relationship between them, and in which cases one is better to the other? These are some of the aspects that we will be looking at in this chapter. So, the basic understanding in these two areas, again, both are both are related to the profits, based on the profit or net income generated by the company. Both are based on the net income. Company has generated some profit. Using that profit, should it give dividend or should it buy back some of the existing shares? So both of them have that kind of a linkage. Whatever the net income the company has generated, for what purpose it has to be used, to what all uses that the net income can be put to. So from those standpoint, we will be talking about these two concepts. So from a dividend standpoint, we get to some of these things like the company can give a dividend. Dividend is nothing but whatever the regular amount or whatever the amount that is really paid to the investors, to the shareholders. Whatever the company pays to the shareholders, the term that we use for it is dividend. As long as the person is holding the shares, not selling off and getting the excess amount, as long as the person is holding the shares, whatever the company is paying to that shareholder at different intervals of time, we are calling that to be the dividend. So that dividends, either they could be in a cash form or they could be in the form of stocks, is additional shares. In a typical some countries parlance, this is also called as bonus shares or bonus issue. There are so many names to it. So the typical term which we are going to use is stock dividend, which is nothing but the payment to the investor is not in the form of cash but in the form of stocks or new shares. So in case of cash dividend, again, what will happen, what when the company is paying some money out of its profits to the investor, what is going to happen? The size of the profit is actually coming down. Whatever is the worth of the company, right? Whatever is the scope of the company, value of the total company, if some amount is going out from the company, the value of the company is decreased by that much extent. The value of the assets of the company, because cash is also one asset, the value of the assets of the company are going down by that much extent. On any day the dividend is paid, it's like some money is moving out from the company to the pockets of investors. The day the movement happens, it will reduce the value of the company's assets, and the overall equity is also coming down, because otherwise that entire portion would have been retained. If the company doesn't pay any dividend, it goes as retained earnings. If it goes as retained earning, the size of the equity is going up. Now, if that some portion is paid as a dividend, the retained portion is coming down. So the size of the equity is also coming down for the company. So this kind of analytical approach is very much required for us in solving all the questions, right? So basically what goes up, what goes down is some of the things where we have to give more and more stress on in understanding these kind of concepts, right? Now, coming to the dividend, from a company standpoint, there are three types of dividend. Companies talk about a regular dividend, a special dividend, and a liquidating dividend. What are they? Regular dividend is something which is paid every year. And one thing before we discuss something more on this. The dividends are always declared as a percentage of face value, right? Sometimes a company says we are declaring 5,500 percentage as a dividend. It doesn't mean that 5,500 percentage of the share price is given as dividend, or it has nothing to do with that. The dividend always is given based on the face value of the share. If the face value of the share is, let's say, 1 rupee, there are some shares whose face values are 1 rupees. There are some shares whose face values are 10 rupees. Like that, you will find different shares, they have different amounts of face value. So, when we talk about dividend, we have to look at, they'll simply say we are giving this time 5,500% in the form of dividend, or we are declaring a 40% dividend. It's not 40% of the profits given as dividend. That's a very common wrong notion for the people. It's not 40% of the dividend, profit given as dividend. When they say we are giving 40% as dividend, it doesn't mean 40% of the profits are given as dividend. It means 40% of the face value is given as dividend. So if the face value is 10, then 4 rupees per share is what is given as a dividend. So even if the company is saying we are giving 5,500 percentage as dividend for a share value, for a face value of 1 rupee, it means only 55 rupees per share is what is going as a dividend. Right? So here comes the three categories of dividend: regular dividend, special dividend, and a liquidating. Regular is something which the company declares more or less every year. And this regular dividend, the company doesn't want to increase drastically or decrease drastically also. Because generally we see the regular dividend will be more or less consistent every year. Right? Probably if they are declaring 200% every year, they'll try to maintain it around that same 200%. Slightly more, slightly less, but not drastically more or drastically lesser, because it's the first prima facie information which any investor will basically expect from the company. Okay, this company is going to give me some 20 rupees per every share, right? So it's a minimum expectation which the investor will set every year, just like we get interest into our bank accounts every year. Right, the moment we have a fixed or savings deposit, we expect some basic amount to come into our account every quarter in the form of interest. So the regular dividend also is typically observed from that standpoint. Okay, more or less the company will give me 20 rupees a share every year in the form of dividend. So that's where companies don't want to tinker around with it very heavily. Because very high means, if let's say they have suddenly increased it to 30 or 40, it means from the next year the expectations of the investors will even more go up. And if the company is not able to generate that much of heavy profit in the next year, so the expectations will go down drastically, which will have an impact on the performance of the share in the market. Right? So they don't want to give very high or very low as a part of the regular dividend. They try to maintain consistency in the regular dividend process. So it's like investor is more or less confident that the company is going to give something like this. So if that regular dividend is not given, the investor will start thinking negative about the performance of the company, because every year they were able to give this much. Why not they give it this year also? So is there something that has happened? Even if a person doesn't have too much of a financial statement knowledge and all those stuff also, he'll expect that amount to be given every year. And so that's what goes as a regular dividend. Right? And if they have given higher regular dividend, it means that every year they may have to meet those expectations. Otherwise, it looks like last year when they have given, why not they give it this year? So that's where they try to maintain the consistency in the regular dividend process. When it comes to special dividend, these are some of the cases marking some special occasions of the company, wherein they'll say this year we'll give another 500% extra. Probably they'll link it to some event, right? Probably let's say the same 5,500 every year. They cannot give that 5,500% dividend. And this was the case of one of the companies itself. The Hero Motorcorp has actually given it in 2010. And the number is significantly higher. Every year they were giving only 35%, 40%, or probably 100%, 200% in the form of dividend. But suddenly it rose to 5,500% of the face value in one single year. That was marking their silver jubilee year or something like that. So Infosys sometimes it has given when it has reached $1 billion company mark. So in some of the years, just as a gratitude to the existing investors, what they will not club it as regular dividend, because then again next year the expectations will go up. They'll package it as a separate thing, special dividend, and say because of this we are giving you something more, so that the expectations will not be there in the next year. So we are declaring a special dividend this year, some such kind of a statement will come. So those things, they are there. So that's also some kind of cash which the investor is receiving. The moment investor receives the cash, all these things will happen. The value of the company will go down by that much extent, even the market value of the equity, and then the share price also will go down by that much extent on that spot, because it's like investor has already received some benefit. So share price has to go down by that much extent. If he has already received some 20 rupees, right? If he sells, let's say he can sell it at 2,000. Out of that 2,000, he has already received 20 in the form of dividend. So basically now all he is supposed to receive is only 1980. So the share price goes down to that extent from a reality standpoint also. So the market value of the equity will go down. The company's assets value will go down, because there is a cash outflow from the company, any dividend. And the third is slightly a negative form. Liquidating dividends generally are applicable when the company is winding up. When the company is winding up, whatever the final thing that is left after paying to the lenders and everything, whatever the final thing that is left, that is what goes to the equity investors. So the liquidating dividend is basically that dividend, that portion of their investment that goes to the equity investors when the company is winding up. So though the first and second are looked more in the form of positive, the liquidating is a kind of a negative aspect of the company, because that comes up only when the company is winding up or closing some portion of the business, selling off some portion of the business, and that amount it wants to distribute to the investors. Those kind of cases we bring in the liquidating dividend. And when we are talking about the stock dividend, the issue is in the form of shares, so that no cash goes out of the company. Just try to look at this scenario. If I am giving an additional share to you, right, no cash is going out from the company, but the number of shares are going up. Number of shares that are available in the market are going up, because I am giving new shares. I am not adjusting the existing shares. Right, a bonus issue or a stock dividend is the process of issuing new shares. So from 100, the number of shares will go to 200 or 150 or something. The price will come down by that extent, because the market value is not changing. Right, the new shares are given for free without extra capital, which means the total market price should be distributed among all the shares. So the price of the share will typically come down, but the advantage is cash remains within the company. There is no cash shortfall within the company. So whenever the company wants to retain a large portion of cash, and it does not want to give in the form of cash, what it will very well do is it can resort to the stock dividend kind of a process. Now, whatever is the form of dividend, there are some other forms of reinvesting the dividend. In some cases, individual shareholders can opt for the dividend reinvestment plan, which means the difference between a stock dividend and a dividend reinvestment plan is in stock dividend, the company will make it as a mandatory thing for everyone. We'll give you additional share. Whereas in a dividend reinvestment plan, it is optional. If you want to take it in the form of cash, you take it. If you want to give that cash back to us and take additional shares, we'll give it to you. So dividend reinvestment plan is more at the discretion of the investor, whereas the stock dividend is more at the discretion of the company. Both of them are one and the same. But in the dividend reinvestment plan, at least the flexibility exists with the investor whether he wants to reinvest and reinvest for additional shares or continue with taking the cash itself. Whereas in case of stock dividend, the company itself mandatorily issues a dividend. And one more thing we have to look at in the context of the stock dividend is stock split. Sometimes we say stock split. In some contexts, we also use reverse stock split. Now, we have to understand this aspect. Stock split has nothing to do with the performance of the company. Our stock split is purely a stock market activity. It is not a corporate activity. See, dividend, whether it is in the form of stock dividend or cash dividend, it's a part of the corporate activity. Some cash is really being paid either in the cash, something is paid from the company to the investor, either in the form of cash or in the form of additional shares. So these two are more based on the performance of the company. Whereas when I say stock split, split also increases the number of shares, but they are not additional shares. Split also increases the number of shares, but they are not additional shares. The existing share itself is broken into two pieces. So which means in case of a split, the face value will come down. A 10 rupee share, when it is split, it becomes 2 5 rupee shares. Whereas when a stock dividend is issued, there are two 10 rupee shares that are, one extra 10 rupee share is being issued. So the face value does not come down. Market price may come down. In both the cases, the market price comes down in the same way. But the typical way where the company operates on stock split is, especially if the stock price has gone up drastically in the market and people are not able to buy it at a very high price. Let's say the stock price is 1000 rupees a share and not all people are able to buy it. Forget about how the company is performing. Let's say the stock price is 1000 rupees a share and the company felt that not too many investors are buying at 1000 rupees a share. So let's just break it into 10 shares of 100 rupees each. So 100 rupees means it becomes affordable for a lot of people. So it brings liquidity into the market. So irrespective of the performance of the company, the stock split can target only the market activity. Stock split is directly playing on the stock market and the stock price. It has nothing to do with additional benefit that you are giving to the existing investor. So in case of cash dividend or stock dividend, you are giving additional benefit to the investor. Whereas in case of stock split, you are giving no additional benefit to the investor. Whatever he is holding, you are just splitting them into pieces, right? And reverse stock split is nothing like you are combining two or three shares into one single share, so that the per share price actually increases and the number of shares actually decreases. So when you want to bring that kind of an aspect, you will do a reverse stock split or a stock merge. When you want to decrease the price of share in the market so that it becomes more and more affordable and lot of buyings and sellings can happen, the main intention is to bring in liquidity into the stock market. In that case, you will resort to stock split kind of a mechanism. So though both the stock split as well as stock dividend mechanisms, both of them, they decrease the price of the share. Per share, the price will go down. But few things is the face value remains the same in case of stock dividend, but it also gets reduced in case of split. That is one major difference. Whereas when it comes to the market side, overall wealth of the investor, both in case of stock dividend or stock split, at that moment both of them are same. At that moment both of them are same. Either when you look at it in terms of drop in the share price, or even in terms of the total value of the shares which the investor is holding, or the percentage ownership also, because all shares are doubled, so the percentage ownership also does not change. But the biggest change is when it comes to the dividend, there could be a change because the face values are different in both of them. That's one aspect. And two, from a mindset standpoint, as I already said, stock dividend or cash dividend is more looked at as the growing profitability of the company, whereas the stock split is primarily looked at from the perspective of liquidity in the stock market, creating more and more liquidity in the stock market. It has no direct influence on the profitability of the company, performance of the company, no direct influence on it. Whereas the stock dividend and cash dividend are primarily derived from the key internal performance of the company itself. So we have already talked about all these things. Just a quick look at the regular dividend being the more common kind of stuff. It represents a commitment. So regular dividend, again, in different countries they do a different kinds of payment. In US we see quarterly dividend. So they want to make sure every quarter mandatorily this much is being paid to the investor. So they don't want to set too high or too low kind of numbers there. Here we see annual itself, but in some cases we see interim dividend here in India. But generally it's an annual dividend consistently across all the company. So the more and more consistency is a sign of consistent performance. And if it is consistently increasing every year, it's an indication of very good increase in the profits of the company. Because the expectations year over year are going up. And if the company is able to meet those expectations every year, then probably the price and everything of the company are typically going up. And special dividends, otherwise you call them as irregular or extra dividends. Only under special circumstances you give in addition to your regular dividend. And generally, companies in cyclical industries. What are these? Cyclical industry is nothing but in some cases there will be a boom, in some cases there will be a drop. So they what they want to do, let's say real estate industry, probably in few years they will be at a very big peak. In some years they will lose out very badly. What they try to do is, in those years where they got real exceptional profits, they share a significant profit with their investors, so that their investors will stay with them in times of bad times, right? Because they feel that, oh, in good times this company is anyhow going to give us a bigger dividend as a special dividend, so probably even 1 or 2 years are bad, let's not sell off our share. So such kind of mechanism typically comes up, and that's the reason we see special dividends very largely existing where the industries or business is more cyclical in nature, so that the cash conservation, even if they don't declare dividend in the bad year, they are still better off. And the liquidating, as I have already discussed, it's nothing but it is treated as the return of capital, because when the company is winding up, right, whatever the proceeds that are there, I'm giving back to you. So it's not like a dividend actually. It's like I'm refunding back your capital itself. But whatever is left, you may get more, you may get less, anything you may get, because from now onwards the business will not operate, or this unit will not operate. So we generally treat it as return on capital. So from a taxation standpoint, it is treated as a capital gain or a capital loss, as if you have sold the share yourself and got the proceeds. It is treated in that form, though we use the word called dividend. See, the other two dividends, their taxation is completely different. They are taxed as per the dividend taxation norm, whereas this liquidating dividend is more equated to return of capital, and it is taxed as of in the form of return of capital, which is a capital gain or a capital loss. We can't say when the company is really bad and it has winded off, what I refund back to you will be almost nothing. See, in all these we have already discussed, there is a transfer of cash from company to investors, so it reduces the market value of the equity, and even the stock price falls down by that extent. Because the cash goes down, the total assets will go down, and because the market value of the equity is going down, even the equity is also down. Now, from this standpoint, okay, let's assume the company has declared the dividend. What impact will it have on the various ratios of the company? The debt to equity ratio. We have already discussed that equity will go down because of giving of a dividend, any form, in any form, because of the giving of a dividend, let's say the cash dividend, any regular or special or anything, in any form the dividend is declared, you see that the debt to equity ratio will go up, because equity will typically come down, debt may not change, so overall your debt to equity ratio is going up. Same way, debt to assets, total assets are going down because cash is going down. Cash is going down, total assets are going down, so even your debt to asset ratio also increases. See, why we have to think of all these things is, different investors, they use different ratios as a measure of performance. Why only investors? Even the analysts, they use the different ratios of the company as a measure of the performance of the company. It's not same set of ratios which are used by different people. Different people use a different set of ratios to evaluate the overall performance of the company. So all these things have to be looked at in detail to make an assessment about the performance of the company. Even some liquidity ratios. Let's say when we say current ratio, when we talk about financial reporting, we can even discuss on that. The current assets to the current liabilities. Current assets contain cash. So cash is coming down. So current assets are coming down. So your current ratio will come down. So the typical thing we have to be comfortable in all these things is, if at all one activity happens, what is the kind of impact that it will create in the overall financial statements of the company, overall investors perspective. We have to look at from multiple dimensions. Any activity that happens, what is the kind of impact that it typically creates? So raising dividends is always seen as a positive signal, because the investor really assumes that this company is doing a good job, right? And probably very much hopeful that the company will continue this trend every year, and which will definitely lead to the prices. So even though on the spot, to the amount of dividend that the company has declared, the price falls by that much extent, but that would be for a very short period. If it sends positive signal, more and more buys will happen at that particular point, which will immediately cover whatever the drop in the price that has occurred. So it is always looked at as a positive signal itself in the market. Now, between stock split and stock dividend, we have already seen. See, generally, companies think of, if our share price is between this and this in the stock market, we'll have more liquidity. If the share price is per share more than the higher side, probably only very few buyers will be there. So the liquidity will be much lesser. Only people who can spend a higher amount can buy one single share. But someone who wants to play around with a smaller amount, they don't want to risk. So from that standpoint, companies look at a stock split or a reverse stock split. Why reverse stock split? In some cases, the price is much lower, and sometimes even the exchange, it will set its norms. If the price is below this, we'll remove your stock from the exchange, from the listing itself. In those cases, if they still want to continue their listing, they'll try to do a merging or what is called as a reverse stock split, so that 4-5 shares together become one share. The total number of shares will come down, but per share price will typically go up. Now, one more thing we have to be comfortable of in this case is that the sequence of events, what would happen in case of dividend. So initially, it's the board of directors who announce the dividend, how much dividend should be paid, on what day it has to be paid, and for whom the dividend has to be paid, who are the owners, right? Because constant trading happens, right? Buying, selling keeps happening. So identifying who will receive the dividend, how much dividend, and on what date the money gets transferred into their accounts. This entire thing is what is typically said by the board of directors. So from a timing standpoint, there are 4 important dates we have to be comfortable with. The declaration date, typically the date of annual general meeting or any meeting where the board will declare, we are going to give this much of dividend per share, or this much percentage of the face value, which will work out to this much dividend per share, is what we are going to give for this financial year. That is what is the dividend declaration date. That is not the day where money comes into your account. That's only the day where they have declared the dividend, right? From there, they even announce on that declaration date itself, they announce what is called as the ex-dividend date. The ex-dividend date is like a cutoff date. People who have the shares on that ex-dividend date, right? Who, so just like your employment case, if the company has to give a bonus, they'll say people who are on rolls as of 31st December, they will be given the bonus, and people who resign before 31st December or people who join after 31st December, they will not be eligible for this bonus. The same logic will work in case of dividend. That cutoff date, whosoever are on the shareholders list of the company, as on that particular date, will be given the dividend. So even if I purchase the share on 31st December, I will be eligible for it, because at the end of 31st December, whosoever are the owners, whosoever are the shareholders of the company, they are all eligible for the dividend. Even just 5 minutes before the close of 31st December, even if I purchase the share, I will typically be eligible for the dividend, right? So that is what we typically call as the ex-dividend date. Any date, any cutoff date which is set by the company as to identifying who would be the people who would receive the dividend, that is what we are calling as the ex-dividend date. Now, let's say you have purchased it on 31st December before 4 o'clock. Let's say before the market closed. Let's say at 3 o'clock you have purchased. The shares will come into your account only after 2 days at least, 2 business days. The settlement and everything will take 2 business days. So that is where they come out with to find out who are all the real owners, because this buying and selling happen on the exchange, and exchange takes 2 days typically to do the entire settlement process, right? So the holder of record date typically is 2 days after the ex-dividend date. By that time, all the shares have been allotted to the real owners. The funds have been transferred to the other parties, whosoever have sold their shares. So overall, on that date, whosoever are the owners, that list will be brought out from the exchange, identifying whosoever are the owners and how many shares they own. Because if I have purchased on 31st December, someone else has sold it, the company will not have any idea of who have bought, who have sold, because that entire information is there with the exchange. And exchange takes 2 days to do the entire settlement process. So that at the 2 days after the ex-dividend date is what we call as the holder of record date. That is the date on which I can really identify whom are my true owners or true shareholders of the company and how many shares they really hold, based on which I can really declare the dividend and identify their accounts and then transfer the money into their accounts. So that is what we call as the holder of record date, which is always 2 working days depending on how the markets typically perform, because today it's more of T+2 settlement. Wherever the settlement is taking 2 days, we are saying the holder of record date is 2 days after the dividend declaration date, ex-dividend date. And finally, when I say payment amount, the amount is actually deposited into the accounts, or checks are mailed depending on the process that is existing in different countries, right? The amount could be directly be deposited. The real physical movement of money from the accounts of the company to the accounts of the individuals is what we are calling as a payment date. So these are the 4 dates we have to be comfortable with as a part of understanding the dividend dates of the company. Now the next aspect where we have to be more comfortable with is the share repurchase. Dividend is one aspect where, with the extra profits which the company has generated, it can either issue dividends to the investors, or it can repurchase the shares back because it has some money with it. So when it repurchases the shares, what happens? See, if it gives dividend, there is a dividend distribution, there is a dividend tax for the individual investors. In different countries, the dividend tax norms are different. Whereas, if the company gets into the model of buyback of the existing shares, what is happening? Number of shares are coming down now because the company has bought back some of the shares. The number of shares that are available in the market are coming down. So per share price is directly going to go up. So capital appreciation directly comes up in the market. Without anything bigger difference, you see that the capital appreciation comes up into the market. Capital appreciation comes up in the market because with that number of shares, with that amount of money, the company has bought back the shares. So some amount of individuals, some shareholders always prefer capital gain, while some of them will prefer the dividend. Because see, when they are already, it depends on the tax norms, right? And for some people, probably the capital gains, they are getting more benefit because they are treated separately from a taxation standpoint. So if you are already in the major tax bracket, in a very high tax bracket, you may not get bigger advantage with capital gains thing, but you may get a better advantage with the dividend. So different kinds of mechanisms are given different kinds of importance from different investors' standpoint. Let's say I already have a big loss in some of my other investment. Let's say I have a big loss in some company shares, and there is a profit in this company share. I have two shares. One is having a big loss, the other is having a decent profit. Not a big profit, but a good profit. Now, the loss making company will not declare a dividend, but this company will give some dividend. The profit making company will give some dividend, and I have to pay tax on that dividend. Now, otherwise, let's say my other company is making a huge loss. This company did not give any dividend. My overall capital gain is also a capital loss, because there is a loss there is a gain here. Overall, it's a capital loss. Overall, I don't need to pay any tax. So what typically comes out is different individuals, depending on the portfolio which they are holding, their typical needs. Some of them will prefer capital gains and some of them will prefer dividend. So when any company is doing a buyback of the shares, typically it is trying to reduce the number of shares, increase the share price per share, and that is where it is also providing a choice of selling back your share, because the company will say we'll buy back 5% of the shares. Whosoever is willing to surrender them, please surrender. So the investor has an option here. If he wants to sell back his share, he can sell up. So there is some level of flexibility to the investor, to the shareholder, to decide whether he wants to tender his shares or not. Whereas in case of cash dividend, that does not exist. The company declares a dividend. That's it. Whether you like it or not, you have to take it. The same thing. The company declares a stock dividend. Whether you like it or not, you have to take that extra share. Whereas in case of share repurchase, at least the investor is given some kind of a flexibility whether he wants to tender his share or not. Now, there are different mechanisms that are available in terms of the different methods for repurchasing the shares. One is the straightforward mechanism called open market purchase, where the company will buy the shares just like you and me buy it on the stock market. Whatever is the current market price, they buy the shares at the current market price. That is called as an open market purchase. So if the price is higher, probably they pay more for it. If the price is lower, they pay less for it. That is what we call as open market purchase. At least the flexibility is the company can decide when it wants to purchase. The price is completely okay. If the price has gone down, let's purchase. If the price has gone up, let's stop for some time, because there is no pre-decided agreement or something, right? Whenever it wants, it can do the repurchase back. That is what is the open market purchase scenario. The second scenario is a tender offer scenario, wherein the buying back is happening at a fixed predetermined price. I give an advertisement in the newspaper saying I am going to purchase 5% of the shares back. Anyone who wants to tender their shares, they can tender it. We'll be paying 10% more than the current market price. So generally this kind of a tender offer will go with a premium. They will not purchase it at the market price itself. If they want to purchase it at a market price, probably they can do an open market purchase itself. But generally they will do it slightly at a premium to the current market price. And that too, they do it like a bulk purchase. Fixed number of shares. So even if 20% of the people tender back, they will only choose 5% only. They may use a first come first served kind, or they may do a proportionate kind of a basis. they can use the mechanisms which they will clearly mention on what. But if the tendered proportion is lesser, they'll buy back only that lesser portion. Let's say they have advertised that they will buy 10% of the shares back, but only 4% of the people have tendered, then they'll buy back only 4% of the shares itself. But if 20% of the people have tendered, they may say we'll buy back only the half of the number of shares of each of the investors. We cannot, or if it is first come first served, the first 10% will be bought back, the others may not be bought back. So those kind of things they can very well incorporate. But this is a process where they are buying back from the investors by giving an advanced information to the investor, deciding the price at the beginning itself, and asking them to physically surrender their shares so that they can buy those kind of shares. And the third mechanism is direct negotiation, which is more like, instead of buying the shares from the market, or instead of asking people to surrender their small number of shares, they will directly negotiate with a large shareholder, right? Probably someone who is holding 3% shares, 5% shares kind of stuff. They'll directly negotiate the deal with that person, ask him to surrender. Ask him to surrender his shares, probably at a premium, right? So if I say probably you are having 5% shares in my company, I'll simply ask you, I'll pay you 10% more than the current market price. Would you be selling all your shares? So in that case, probably I don't need to give too much of advertisement, or I don't need to wait until all my investors are surrendering and all. It's a simple block deal. So those kind of things go as a part of the direct negotiation. But in tender offer as well as direct negotiation, the most common thing is there will be a premium to the current market price. Whereas in case of an open market offer, probably you can directly buy the shares at the existing market price itself. Now, one important thing that we have to look at with respect to share repurchase is, what would be the impact it will have on the net income or the earnings per share of the company. If I am doing a share buyback, what would be the impact it will have on the net income of the company? What we have to simply see is, what is the mechanism that is used for the buyback? If the buyback is happening with the existing cash itself, if the buyback is happening with the existing cash of the company, it will definitely increase the EPS, because number of shares is coming down. When the company bought back the share, number of shares is coming down, but at the same time, the overall profit of the company is not changing. The overall earnings of the company are stable, but number of shares is coming down because of the buyback. So obvious thing is the EPS is going to go up. And EPS is a very good measure in terms of assessing the performance of the company. So directly I can increase the EPS of the company just by doing a share buyback. If it is purely by my own funds, let's say I'm not buying it by my own funds, but I'm doing a buyback with the loan fund. I'm not doing a buyback with my own funds, but I'm borrowing to do a buyback. So I don't have a cash with me, but I'm definitely behind a buyback of the shares. At any cost, I want to buy back the shares. I don't have the sufficient cash with me. So what I can do, I can even borrow and do a buyback. So if I do a borrowing and do a buyback, that is where we have to really see whether the EPS is really going to go up or go down. If at all I am doing a purchase through a cash, no doubt EPS is going to go up only. But if I am borrowing and purchasing, there is an interest cost for me. If I am borrowing and buying back the shares, there is a component of interest which is an additional cost for me. So I have to compare the interest, how much interest I am paying compared to how much increase that comes into the EPS. Only based on that I will see whether my EPS is actually going up or going down. Let's take one numerical which can help us in solving this entire thing. So let's say, let me take it into this. So company is considering repurchasing 20 million worth of stock. Okay. Repurchase worth. Let's say the company wants to repurchase something to the extent of 20 million. And so the market price is $40. So the market price is $40 a share, which means how many shares does it want to buy back? 20 million worth is what it wants to buy back, and per share the price is $40. So number of shares that it wants to buy back is this divided by this. So it wants to buy back some 500,000 shares. Now the other information that we have is number of shares outstanding before buyback, 20.5 million. So shares before buyback is 20,500,000. These are the numbers. So shares after buyback we have already. So because we have to buy back 500,000 shares. So after the buyback, the number of shares that would be left is only 20 million. Right? Because 500,000 shares are bought back by the company. So they are no more existing. They are no more existing. The number of shares are actually coming down. So this is what has happened in this scenario. Okay. The EPS before buyback is $3. So EPS before buyback is $3 a share. What does that mean? What is the total profit of the company? Net income of the company. I can find out from this. What is the net income? The EPS, earning per share into number of shares, is the total earning of the company, total net income of the company. So the earnings per share into the total number of shares before the buyback. So the total earnings of the company are this much. Right? Total earnings of the company are this much. Okay. And the earning yield. Okay. So what is the, so the EPS is this much. Right? So let's go ahead. So these are the, this is the total net income of the company. Forget about this statement. Don't bother about this right now. I'll come back to this. Then after tax cost of borrowing is 6%, which means the company has borrowed that amount at 6%. What is the amount it has borrowed? This much amount it has borrowed. 20 million is the amount that it has borrowed to repurchase the shares. And we are saying the interest rate of borrowing, is how much? 6%. So that means how much interest actually the company should pay corresponding to this interest rate. It should pay an interest of 6% times 20 million which it has borrowed. So the interest it has to pay is 1.2 million. So its earnings will come down by that. I mean, if they have used this borrowing mechanism, its earnings will come down by 1.2 million. So probably what I am saying is earnings after buyback. Once the company has bought back, the earnings are coming down for the company because it has to pay an interest of this much. So from the earnings, from the net income, I will subtract the interest portion. So the earnings are this much after the buyback. So from here I can find out the EPS after buyback. So which is nothing but the new earnings divided by new number of shares. So which is becoming 3.015. Earlier the EPS was 3. Now the EPS was 3.015. So can we say that the EPS always goes up if I do a repurchase of the shares? Now just take this example. If the borrowing rate, here we have taken that the borrowing rate is 6%. Now let me take an example of borrowing rate as 10%. Instead of 6%, let me take it as 10%. Look at what has happened to the EPS. It has gone down. From 3, it has fallen to 2.9. Which means when I work out with borrowed money to buy back the shares, when I work out with my own cash to buy back the shares, the EPS will always go up only. But when I work out with borrowed funds to buy back the shares, in some cases the EPS is going up. Right? When I have taken the interest rate as 6%, borrowing rate as 6%, the EPS has actually gone up. So in some cases the EPS is going up. In some cases the EPS is going down. In which case the EPS will go up? One is when the interest rates are very less. If the cost of borrowing is very less, the EPS is going to go up. The higher the cost of borrowing is, the EPS is going down. But what is the cutout point? The cutoff point is what is decided by what is called as a dividend yield. The dividend yield of the company, which is nothing but dividend divided by the stock price. Dividend divided by the stock price is what we are calling as the dividend yield, or probably the earnings. Probably in this case we can talk of it as earnings yield. Instead of dividend yield, we can talk of earnings yield, where we talk about earnings by stock price. So you look at earnings per share by stock price per share, it is 3 by 40. 3 by 40 earnings per share is 3, market price per share is 40. So the earnings yield is 7.5%. So as long as your cost of borrowing is less than 7.5%, the EPS is going to go up. So probably even if I put it as 7% here, my EPS is still going to be higher only. But if my cost of borrowing is higher than the earnings yield, my EPS is going to go down. Right? So especially when we are working with borrowed funds, right? If the cost of borrowing is much lesser, the EPS is going to go up. If the cost of borrowing is higher than the earnings yield, the EPS is going to go down. Cost of borrowing is exactly same as earnings yield. Let's say this rate is exactly 7.5. My cost of borrowing exactly same as earnings yield. Then the EPS also will not change at all. EPS also will be 3 only. So this is one kind of relationship you have to develop, right? Especially when you are doing a buyback of the shares with the borrowed funds, you will check these two things. Cost of borrowing, which is the interest rate on the borrowed funds. You will compare it with the earnings yield, which is nothing but earning by the current market price of the share. So if your cost of borrowing is more than the earnings yield, then your overall EPS is going to come down. If the cost of borrowing is less than the earnings yield, your overall EPS is going to go up. And cost of like this here, when you are using the borrowed funds, earnings to price ratio, which is nothing but the earning yield, the earning EPS divided by the market price, which was nothing but earnings yield. If the earnings yield is equal to cost of borrowing, the EPS does not change. Earnings yield is more than the cost of borrowing, EPS will increase. Otherwise, the EPS is going to decrease itself. So it's not that it's not constant in all the cases that the EPS will increase with the share buyback. Only if you are buying back with your own funds, I can definitely say that it will increase. But if you are buying the shares back with the borrowed fund, as long as your cost of borrowing is lesser than the earnings yield, your EPS will increase. Otherwise, it will decrease itself. So that is one aspect we have to be comfortable with. Then, what is the impact? So these are two major areas that are being discussed with respect to share repurchase. The share repurchase, what is the impact it has on EPS, which is what we have seen just now. The share repurchase, what is the impact that it has on the book value per share? Right, the book value per share is not from a market standpoint. It's purely from the accounting standpoint. So now what we are saying, the share price, let's say, is $40, and the book value is this much, and these are the number of shares. Now the company wants to buy back this much of worth of the shares. So this much of worth of the shares means how many shares it is planning to buy back? The 10 million divided by 40. Those many shares it is willing to buy back, because that many dollars worth it wants to buy back. And the current market price is $40. Okay, let's try to put it. So let's say the price is 40, book value 800 million, number of shares 40 million. So what is the book value per share? I can find out here, because the total book value is 800 million. Number of shares is 40 million. So the overall current book value per share is $20. $20 is the current book value per share. Okay, now let me assume that the company is buying back 10 million shares, 10 million worth of shares. Okay, buyback amount is 10 million worth of shares. So how many shares are bought back? The number of shares that are being bought back is this divided by 40. These many shares are bought back. So 250,000 shares are bought back. So shares after buyback, the same logic. Shares after buyback, how many are there? Whatever were the initial number of shares minus whatever are the shares that are available after the buyback. I mean, whatever are the number of shares bought back, these are the number of shares that are available with the company after the buyback. Okay. Now what is that we are saying? Find the book value per share. Okay. Now look at what is the book value per share now. These are the number of shares that are available after the buyback. And even the book value will come down by the extent of buyback. Because you're buying back 10 million worth of the shares. 10 million worth is coming, is bought back. So the new book value is down by 10 million. So your new book value is nothing but 800 million minus 10 million. So the new book value is 790 million and the new number of shares are 39.75 million. And based on this, you will find out your new book value per share, which is nothing but this divided by this. Book value per share has become 19.87, which means it has decreased. The original was 20. Before the buyback, the original book value per share was 20. Now it has become 19 point, which means it has fallen. In what case it has fallen, or will it fall always? Now let's say if the market price per share was instead of 15, it was instead of 40, it was only 15. The book value per share has actually gone up 20.08. So here the relation for us is compare the market price with the original book value. Market price lesser than the original book value, it will increase your book value per share. The share repurchase will increase the book value per share. If the market price is higher than the book value per share, share repurchase will decrease the overall book value per share. Right? What is the impact of share repurchase on book value per share? If the book value is more than the market value, it will the share repurchase will increase the book value still. But if the book value is lesser than the market value, like in this case, the book value lesser than the market value, share repurchase will keep reducing the book value after the repurchase. So this is one more relation we have to be comfortable with. So the book value per share will increase if the market price of the share is less than the original book value per share. Otherwise, it is going to decrease. So we have to be very much comfortable with these two kind of numericals as far as the share repurchases are concerned. What is the kind of an impact the share repurchase has on the earnings per share one, on the book value per share as a second thing. These are the two aspects we have to be very much comfortable with. And okay, now deciding between the cash dividend versus share repurchase from an investor standpoint or from a shareholder's wealth standpoint, if there are no taxation differences, both are one and the same for the investor. Whether the company gives a cash dividend or it does a share repurchase, from the investor standpoint, there is no difference as long as there are no taxation differences between the two. Because dividend, there is a separate form of tax. Dividend is the dividend tax, which is more like an income and you are paying a dividend tax on it. It is treated as a part of the income and you are paying a dividend tax on it. Whereas share repurchase is treated as capital gain. Share repurchase is typically treated as a capital gain, and the tax on it is treated as a capital gain tax. So if the tax differences exist between these two forms, depending on which one is cheaper, that one would be preferred by the investors. That one would create more value to the investor. But if assuming that the tax differences are the same in both the alternatives, the investor is really indifferent between the company going for cash dividend versus a share repurchase. The shareholder wealth will not change in both the cases under the assumption that the tax treatment is same for both of them. So, I mean, this is what in a nutshell this chapter is typically dealing about, wherein the cash dividend, different forms of cash dividend, and even the share repurchase, different forms, what impact it has on the ratios, especially the EPS and the book value per share, are some of the things we have to be comfortable with as far as this chapter is concerned. Right?